Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, April 17th, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. Been a little bit of a rough start here to this week. That continued some weakness from last week, and trying to rebound, but a couple of things standing in the way. Number one, probably one of the most important things is the volatility index, which I've followed closely, I've tracked, I've researched. And when that volatility index goes through 20 and starts trading above 20, we can expect much more volatility and usually lower prices. And sometimes those sell-offs can be pretty quick and severe. So this is kind of a warning sign. It's kind of like you see really dark clouds coming in close to you. They got the sirens flashing for a possible tornado. And now we're just waiting to see if the tornado actually evolves or not. That's the way I look at the VIX. As that VIX goes higher and higher, those storm clouds are looking nastier and nastier. And so it's something you might want to make sure you have an umbrella when you go out for sure. But you might not want to go out at all, depending on how this plays out. Now, many times the VIX will top around 20 as well. And if that occurs, then we are likely to see a very, very strong rebound. The question is, which one is it going to be? I wish I had the answer for you. I don't. So I think it just comes down to each individual as far as how much risk you're willing to take. I think from a long-term perspective, if you're looking at where we're going to be 2 years, 5 years, 10 years from now, I believe this is going to be a blip on the radar. But to a short-term trader who's trying to keep capital intact, this can be a very, very trying period. And I think that risk is significant whether you're long or short. Because again, VIX goes through 20, I think the longs could be in some trouble here in the near term. But if the VIX tops near 20, then I think it reverses and all of a sudden the shorts are going to be feeling the pain on a reversal. So again, not sure which way we go. I'm going to be watching like everyone else. There are some signals to me that suggest this is not going to last. But again, as a short-term trader, if we go down for 5 days and that VIX goes through 20 and hits 23, 25, maybe even 30, big losses certainly can ensue in the near term. One thing that I'm watching pretty closely too is the 10-year Treasury yield. And we'll take a look at the chart of that. But we hit a key area of resistance. We made a measurement that we've been talking about for really the last few weeks, where we had a breakout of a cup that measured on the 10-year Treasury yield up to 466. We closed right at 466. Intraday, we went up to 470, which was also a key gap resistance level on the 10-year Treasury yield. And so that 466 to 470 area, I think, is really important. There's been a direct inverse correlation between that 10-year Treasury yield and the small caps in particular. And I think a lot of that probably relates back to what's going on in the small and mid-sized banks. There's still a lot of folks worried about them. I'm one of them. I mean, we've seen large banks do pretty well, but the smaller, medium size have not kept up. They have been underperforming. And technical analysis usually tells us that, hey, there's probably an underlying reason for that. Continues to be. I can tell you that my belief is that we're going to get rate cuts, but as more and more folks, especially the Federal Reserve, talk about delaying those rate cuts, that is then delaying the return, or at least the start of the return of these small and mid-sized banks back to health. So I kind of throw my hands up right now because this is a pretty cautious time, or a time to at least be on your toes. We're already seeing a lot of that whipsaw back and forth. So, I mean, it's going to take some intestinal fortitude here to probably navigate this next week, maybe couple weeks. We don't know. Another thing I can say, and then we're going to get into the charts, take a look at what happened yesterday. But one other thing I could say is that we have had early returns on earnings that have been, for the most part, spectacular. Many of the companies reporting right now are the more value-oriented, larger cap names. We know that there was a lot of rotation into this area in the first quarter, and we're seeing why in terms of some of these earnings reports that have been coming out. But anyway, let's go ahead and get this thing started. Let me make sure I got my screen ready to go here. Okay, let's jump in to the action from Tuesday. We had the Dow Jones Industrial Average actually finish up 64 points. That was a little less than 0.2%. S&P 500 down 0.2%. NASDAQ 100 pretty much flat. Mid caps down 0.5%. Small caps down about 0.4%. And the transport's down just under 1%. And you look at this and you say, well, what's the problem? I mean, pretty much just kind of flat. Fractional losses here, fractional gains there. Well, the big problem is that it's in the middle of a downtrend. So there's nothing yet to guarantee us that this downtrend is over. So we could see, morning strength. I know the futures. Let me give you those numbers here. On the futures this morning, we've got the diamonds right now up 0.15%. The spider up 0.41%. That's a little higher than when I looked earlier. QQQ up 0.35%. And the IWM up 0.42%. So looks like we're going to get off to a pretty good start, but we are still in a downtrend. Even if you look at like a 5-day, 10-minute chart, we really need to take out the highs and at least start to kind of turn the charts in favor of the bulls. If we go back down to another new low, expect that VIX to be moving back up. If we do move down to another low and the VIX kind of goes sideways or doesn't really follow suit to the upside, that could be an early bullish signal that fear has kind of reached its peak and it's kind of rolling over. Because normally when you get new prices, lower prices to the downside, normally you'll get that higher VIX reading. So that'll be something to watch. I mean, I know it's just one small signal, but it could be something that kind of changes the complex or the character of what we've been seeing in this downtrend of late. Anyway, moving on, let's talk about sectors. Technology down, up yesterday about 0.1%. That was the best performing group. And if you look down at the bottom, we saw real estate down 1.5%, utilities down 1.3%. I mean, when I see that, I see all the fear coming into the market. I hear all the talk about higher inflation maybe, and maybe the Fed's going to have to raise rates, blah, blah, blah. And then I look and I see technology, one of our aggressive groups, leading and two defensive groups lagging badly. It doesn't really paint the picture of, some sort of Armageddon ahead. It's more like this is more of a temporary thing to the downside. And that's the way, I view the market. I try to look at the signals under the surface. I mean, sometimes, you get in the car and you put it in, maybe if you have an older car, you put it in drive and something happens and see smoke coming out. And, your overall thought is that my car's not running, but there's something under the hood. You have to look under the hood. It might be a really big problem, or it might just be a hose needs to be connected or something really simple. And so when I'm looking at the market, trying to figure out, okay, are we in big trouble or are we, poised maybe to rebound? It's from looking under the hood to see, is it a simple fix or is it something that's really starting to build? And again, what I'm seeing right now tells me we're going to rebound. But the question is when? Do we have 2 or 3 more days of weakness? Do we go down another 5%? Do we actually get a correction? I remember back in July of last year talking about the market coming up into a period that just looked like, there was a little turbulence ahead. And my suggestion, I think back then, is that we might lose 2, 3, 4%. Ended up losing 10, but then we went back to all-time highs. So when I see maybe a little bit of turbulence, and I was talking about this last month in March, I said, hey, I think we could see maybe 4 to 5% down. And we didn't see it in March. Now we're seeing it. But the VIX also has quickly moved up to that 20, close to that 20 level. And that's another piece of this puzzle that we really need to watch closely. Anyhow, moving on to the industry groups, healthcare providers, big day yesterday. Most of it was a gap, though. We gapped up over the 20-day and then we sold off. We just happened to finish still higher by about 1.9%. But that was not exactly a bullish candle that I saw yesterday there. So I'd still be careful with that group. Aerospace, though, did go up 1.41%, bouncing off of its rising 20-day. Its pullback has been very modest so far. And the breakout that we saw took out the high that we had back at the end of December. So this is a group actually that on this pullback looks pretty good. There aren't too many of those right now, but this is one. Semiconductors had a huge run. We should be very willing to allow this group to pause for a while. In fact, if it had continued moving up, I mean, it was absolutely beginning to look parabolic to the upside. I would prefer seeing some consolidation, kind of letting those gains be absorbed before possibly moving higher again. We'll see, but right now we're at a big level on the semiconductor, so keep this in mind. We did finish up 1.26% yesterday, but we've gone down. We've tested some recent price support from the last 4 to 6 weeks. We're at the 50-day moving average. PPO is now back to the center line. This is a group that is really important during a secular bull market advance. So if we do start to see a rebound, this is a group that I'd like to see start to show more strength, especially as we begin to head towards some of the big earnings in that area. All right. One thing I wanted to mention before we get into the charts, I did post a daily 5 video over at Stock Charts yesterday. They have guests that come on all the time to present 5 charts that are meaningful to that guest. And so I was on yesterday. You should go over and check this out because I did give probably about a, 17, 18, actually almost 19-minute video on 5 key charts that included the VIX. It included the 10-year Treasury yield, the IWM, Apple, QQQ. I think it was those 5 charts that I looked at. And so I think it would be a good idea. If you want that title right there, VIX above 20, just put that in the search box and this should come right up. Or find me with my name and daily 5 or stock charts or whatever. You should be able to find this video, but definitely check it out because I think there's some really good information, educational information, just from history and what we can learn from history and what we might expect. So be sure to check that out. 10-year Treasury yield. So let's get an update this morning. Down. That's good. So it looked like maybe we were topping yesterday. Today, so far, looks like maybe we're following through to the downside. But let me give you a couple things that I'm watching. First of all, that was the high, that 470 on this gap down at the beginning of November. We gapped down, traded back down close to 460, finished probably at about 468 or so, but the intraday high was 470. A couple weeks later, where did we go? We had a high right back to 470. Couldn't get through. So 470 is a level. Then we also have, of course, 5%. That was the high back in October. That's where we were when this whole bull market started. What's interesting is as we get closer and closer to that 5% level, the S&P 500, or in this, I don't know exactly where we were. I think we got down to a low of about 4,100 on the S&P 500 when we were at 5% before. We're not that far from 5%, and we're almost 1,000 points higher on the S&P 500. So in my opinion, the fact that rates are up here and remaining high probably has more to do with our economy remaining strong than it does inflation, at least in the long term. Now, maybe short term, it's inflation fears that are kind of stoking the selling of bonds and driving the yield higher. But it's not totally inflation because, again, inflation, if we were really, truly in a big, had a big problem with inflation, I don't think we'd be looking at the S&P 500 right now over 5,000. Quite honestly, and legitimately, I think we probably would be back down in the 4,500 range. If inflation truly is rekindling and it's not dead and it's going higher, I believe the stock market will go down. I just don't believe inflation's going higher. So if you say, hey, what are some of the things that could derail your, bull market call? Inflation, no doubt. If inflation were to really start to tick back up, and I mean get meaningfully on an annual basis back above 4 and especially 5, that would be something unexpected for me. I don't think we're going back there, but we'll see. The other thing was this cup. This is the other thing I wanted to mention. So if you're new to the program, haven't seen this. Anyway, we were trending higher on the 10-year treasury yield. We put in this cup, went from 435 down to 404 on the yield, 4.35%, 4.04%, all the way back up to 4.35%, put in a handle, broke out. The depth of the cup, 435 to 404, is 31 basis points. You add that to 435, you get 466. And where did we close yesterday? 466. And today we're bouncing off of it, moving back to the downside. That could be key to a run to the upside. If the yield starts moving back down, I would expect that we're going to get a recovery in stocks. That's what I would expect. And I think small caps would certainly benefit because they're the ones getting hit the hardest from this rally in yields back to the upside. The VIX, I wanted to bring this up first because obviously it's become a pretty big chart. Yesterday got the 1956. It opened at 1949 though, so it really didn't go up after its open. It kind of came back down, and then even as the market sold off, the VIX didn't go back up to a new high. So if there's a silver lining, and it's a small one at this point, that would be it as far as the VIX goes. But I've done a lot of research on the VIX, and when that VIX gets above 20 and starts closing above 20, that's when losses on stocks can accelerate. So going on the VIX from 12 to 19, yeah, we've gone down some, and especially on this latest rally, this big move here, we've seen some selling in the market, but we're still only down about 4% on the S&P 500 from the high. If this goes through 20 and we start making our way toward 23 or 25 or 30, that next 50% move in the VIX from 20 to 30 ain't going to result in 4% downside. It would result in a lot more downside. So that's why you've got to pay attention to the VIX and make sure it doesn't close above 20. If it closes above 20, maybe it's just a one-day thing and back down. But if it closes above 20, you have to recognize that if it is starting a major uptrend in the VIX above 20, that is when historically the stock market gets hit the hardest. So that's why I'm watching 20. Below 20, the stock market tends to perform well. Obviously, the 17 to 20 area, the volatility starts to pick up. We see a lot of movement back and forth. So what do I want to see? I want to see that VIX get back down below 17. 20, we're kind of in that range right now. We got up to 17, 18 over here, got to about 17 here, and then we finally broke out. So now it's that 17 to 20 range. Watch the VIX. Let's see if we can get it closed back down below 17, get that 10-year treasury yield maybe coming back down, and then I think you'll see the start of a rebound. S&P 500 breaking down on the daily chart, and you might say, well, how can you be possibly looking for a reversal with the first breakdown of the 50-day moving average since, we broke above it in November? Good question. When we broke below in August of last year, it ended up leading to a correction. Maybe this one will as well. But one thing I will say is that if you look at a weekly chart on the S&P 500, you can see that we have not crossed below that 20-week moving average. And with the PPO very strong at the recent high, normally the first pullback holds that 20-week moving average. If you go back and you look from 2020 to 2022, 20-week moving average was basically, that was entry point. Anytime you tested it, here we went slightly below it. Here we tested it. Down here we tested it. Here we had a quick little test of it. Here we tested it. Here we tested it. And it wasn't until other corroborating indicators surfaced that we had some issues ahead, that the market actually made a meaningful top. So I don't see those same indicators that I saw back at the end of 2021. If you're new to the program, yes, I did say before this all started that we could see as much as a 25% decline. I do have signals that tell me when to be really, really cautious. Not seeing those right now. So I'm going to do what I do. I follow my signals. I don't follow the media. S&P 500, there you go. So on that weekly chart, still looking okay. Again, NASDAQ breaking down here on the daily chart. But if we go to the weekly chart, what do we see? We still see a price action above that 20-week moving average. Back during the correction of last summer, we did see one scary candle there, well below both price support and the 20-week moving average, but right back above it. So as long as we hold this rising 20-week moving average, I'm okay. But if we fall below it, you're likely to see that VIX over 20. And at that point, you need to see that recovery. Don't expect the recovery. We need to see it. So that's what would take me out of the market, at least temporarily. IWM, this is the weakest of the week. As I mentioned, there's a very, very strong inverse correlation right now. Not always, but right now, there is a very, very strong inverse correlation between the direction of the small cap IWM that tracks the Russell 2000 and the direction of the 10-year Treasury yield. Inverse relationship. We've seen that 10-year Treasury yield. If we go back over here, since the beginning of the month, you can see that huge move up. Go back to the IWM, beginning of the month, huge move down. That's what's been going on for a while now, certainly in 2024. So if that yield is rolling over, showing it today, then we should expect to see some additional strength in that IWM, or not additional, but renewed. Look for a rebound. Transportation wasn't looking good yesterday. We had closed below that 15.4 level that had been holding, and we kept going lower. 15.2 is a major support area. We really want to see transports bounce from this 15.2 level. That's a really big breakdown on the transports. It would be probably one of the more significant breakdowns that we've seen if we lose 15.2. So this would be one of those things where I'd put a check mark in the bear's ledger. If transports can't hold 15.2, that, in my opinion, that chart starts to look much, much more bearish. Right now, you can argue uptrend, sideways consolidation, which normally resolves itself to the upside. So I can look at this pattern right now, even though we've been weak the last week. I mean, the 2 weeks lead at the end of March, we were bullish. I mean, we've been seeing this back and forth action for the last 4 months. That doesn't worry me. A breakdown would worry me. Moving on. So if you do like earnings beats and what we do and how we approach the market, go over to earningsbeats.com. Make sure you scroll down. We have a free newsletter. Make sure you subscribe to that. Name, email address, hit that subscribe button. We'd love to have you. Also, if you want to try our paid service, you get a 30-day no-cost trial. So 30 days will cost you nothing. We'll even let you know at the end of the 30 days that your 30 days are expiring to give you notice that you're going to get charged after a month. That's the deal. But I think our service is second to none. Give us a try. All right, chart of the day for today. I thought the action yesterday in Super Microcomputer was very, very interesting. This is a company that made just a massive push from, we're talking about the beginning of the year. We were down around 270, 280, something like that. We went up to 1,230 in less than 2.5 months, probably 10 weeks. Massive move. What is that? 4 times? So it went up 300% in 2.5 months. But it also had what I said was the best earnings report last quarter. The market was expecting it, and it got it. It's been great action in the stock really for the last several years. But when it really accelerated was back earlier in the first quarter. So are we now starting to make a pre-earnings run? That was a big hollow candle. Notice the volume picked up, and they report April 30th. So they're going to be reporting here in about 2 weeks. Are they making a move back toward the high before earnings and then a possible another big push? I don't know. Just want to point it out. I thought it was interesting. If you do get into this stock, the only thing I can tell you is that you can look at the chart and see that it is incredibly volatile. So only those with, willing to take on high risk should even think about this stock. But I think it looks pretty good with that candle yesterday moving back above the moving averages. All right, just a couple other charts. We're about to wrap up, but I wanted to show you a couple things. First, the defense index. We just had the drone strike, Iran against Israel over the weekend. And I thought to myself, wow, defense stocks are going to take off Monday. They did actually intraday. They started to move to the upside, but the last couple of days, we've finished on our lows. We've really gotten no reaction in defense stocks from that strike over the weekend. Now, obviously, there's a lot of worry about what Israel's going to do. Will they retaliate? If they do, maybe that's going to be something that drives the defense stocks. So if you think that this is a war that's going to escalate, I would certainly expect at some point that the defense stocks would take off. But I don't know. Maybe the charts are telling us that a retaliation is less likely. I don't know. Just looking at the charts, I was just surprised to see that this week defense stocks haven't moved up. If I asked you, or if I told you that over the last 5 trading days, there have only been 2 industry groups out of 104 at stock charts, only 2 in the last week that are higher than where they were 1 week ago. One is coal, which is just all over the place all the time. It seems to just kind of do its own thing. But this chart right here, footwear. Footwear is the only industry group over the last, other than coal, over the last week that is higher than where it was 1 week ago. So we have seen a lot of areas obviously pushing lower over the last week. Some have moved down less than others, but I just want to mention footwear. I don't think it looks very good, to be honest. I think it was already taking a hit, and when everything else started to sell, maybe some money fell into this group just to, we started off weak on Monday. Maybe there was a little bit of anticipation of maybe a rebound. I don't know. But overall, I'd have to at least see this group get through the 20-day before I'd even start to think about it. Let's see. What else do we have? I wanted to show you, these are all the sectors right now, all 11 sectors. And I want you to look at the bottom, because in the bottom is the AD line. And the AD lines have kind of turned down on some more than others. For instance, I can kind of see the XLP, which is a defensive group, see money kind of rotating out of there a little bit more sharply than some other areas. XLY, it's not really like we're selling off a lot, but we topped about 7 weeks ago. But look at technology remaining strong, even though we've started to see this rollover. Not much weakness in the AD line. Keep all this in mind. The AD lines look pretty good right now, even though we've seen some selling. If I go back and I show you, actually, probably save that one for another day. Here is the XLK back in 2000 to 2003. Look at the AD line continuing to move lower while prices go down. That was distribution. That's what distribution looks like in a secular bear market. So when folks say, well, this isn't good, prices are going down, I'm still seeing the XLK AD line looking fine. So if you're going to tell me this thing's really going to turn over, one signal I need to see is that AD line moving down. Keep in mind, the AD line is based on what? Price, volume. My favorite, my primary indicator is the combination of price and volume. So no wonder I love the AD line, because it's based on price and volume. That's how it's calculated. Go over to Chart School and check it out. Anyhow, it is now getting ready to open the market, and I am going to finish this thing on time again. I don't know what's gotten into the water here, but I've now ended 2 of these events or webinars, shows, whatever you want to call it, before the market opens. So I'm going to wish everybody a great day. We do have a live trading room coming up at 10 a.m. this morning. Take advantage of that 30-day free trial. Come in and join me this morning at 10 a.m. Lots to talk about. Have a great day, everybody. Happy trading.